We're doing a webinar this morning on going public in Canada. And with me at the office today, I have Matthew Couillard, who's a Director of Investment Banking at Haywood Securities Inc. I have Richard Carleton, who's CEO of the Canadian Securities Exchange. On the line, we have Maroof Raza, a partner, National Director of Public Companies at MNP, and Scott Hammond, COO of MGO Ello Cannabis Alliance. The people on the call today and on this webinar represent your Go Public team. And to set the stage on who each of these people are, rather than just telling you their titles, I'd like to throw it to each of our panelists just to introduce themselves and what they're seeing and what they're doing in the Go Public sphere. So let's start with Richard.
Thank you, Sherry. A pleasure to be here this morning on a lovely day in Toronto. Not so much, actually. The Canadian Securities Exchange has a long background with the cannabis industry, back to the earliest days of public cannabis in Canada. We listed our first companies in the spring of 2014. We listed our first U.S. company in late 2016, and at this point have 140 companies in the cannabis space listed on the exchange, now representing not just Canada and the United States, but increasingly from South America, from the Middle East, and from Europe as well. The organization is well known in North America for our advocacy on behalf of the industry. I guess to toot our own horn, I was recognized as one of Canada's 25 cannabis industry power players by Financial Post magazine late in 2018. I also received the American Trade Association for Cannabis and Hemp's Captain of Industry Award in Las Vegas in November. Recently led a team of issuers and investment bankers to the Davos World Economic Forum. That was a couple of weeks ago, where we had Canada Cannabis House on the promenade with approximately 20 companies to provide networking opportunities and to showcase Canada's public market capabilities in financing this industry.
Thank you, Richard. I'll throw it over to Matthew.
Hi, good morning, everyone. I'm Matt Couillard from Haywood Securities. It's an independent investment bank. We also have some retail assets. Our role as investment banker is first to find the companies that want to go public, to assist them through the process of finding the accountant firm, finding the law firm that will work with them, advising the process of finding their board of directors, and all the paperwork that has to be done that we'll elaborate during this webinar. And at the end, to raise the money for those companies and assisting them while they're public with trading support, with research, M&A ideas, and from a subsequent financing.
Thank you. Maroof?
Hi, thanks, Sherry. Good morning, everybody. My name is Maroof Raza. I'm a partner of public companies at MNP LLP. We're a full-service audit and accounting firm. We're coast to coast in Canada. We got involved in the space right at the beginning of the industry in Canada, where with the medical marijuana system, and we helped take a lot of those companies public from the accounting and auditing side. And so fast forward, we now work very heavily in the cross-border space, working very closely with CSE and a lot of the people on this call, bringing companies worldwide, both in the U.S. as well as any countries where cannabis has been legalized. We work very closely with bringing those companies into Canada and helping prepare them from a financial perspective. Thank you.
Thank you, Maroof. And over to Scott.
Thanks, Sherry. Good morning, everyone. I'm a partner with MGO and COO of the MGO Ello Cannabis Alliance. MGO Ello is a professional services alliance that provides advisory, tax, and audit services to a wide range of cannabis companies, investors, and service providers, both in the U.S. and abroad. As part of that, we've taken multiple companies public in Canada, or assisted in the process, and we look forward to hopefully helping some of you with that process as well. Thank you.
Thank you. And as mentioned at the onset, this is Sherry Altschuler. I'm a partner in our capital markets group at Berlis. Berlis is a Toronto-based firm with a national and international cannabis practice. We've been in the sector for quite some time. We started answering questions about the sector in 2014, and now we have a cross-disciplinary group of experts to help you with your needs in the sector. I'll go to our agenda today because the focus of our discussion is going public. And we're going to go through the agenda as showed on this slide. So why go public in Canada? Is your company ready to go public? Certain considerations for listing on the CSE that Richard will take us through. Financial statement requirements that will pull on the expertise of MNP and MGO. And then roadblocks. Common things that we see as a group of experts that we think would be helpful for you to know and consider before going through this process. And the primary question that a lot of people ask is why go public in Canada and why access the public capital markets, particularly in this sector. And I think before we jump into that, I'd like to put the market into context. Viridian does a deal tracker, and the deal tracker for the end of December of 2018 is really insightful and informative to what we're seeing in this sector. So these are in US dollars. For the year ended 2018, there was $13.8 billion raised by companies in the sector, 9.8 of which was raised by public companies in the sector. When you compare that to 2017, it was $3.5 billion total from private and public, and on the public company side, it was just under $3 billion. So we have $13.8 billion versus $3.5 billion raised the prior year. The capital markets activity that we're seeing is tremendous. And it's not hard to see why. You know, Canada is the world's top source for public venture and growth capital for cannabis companies. There's a lot of cultural and social support for this industry. I'd like to get some input from my fellow panelists on why. What's your pitch? Why go public in Canada? I'll start with Matt.
Yes, I think there are two reasons. The first one, as you mentioned, availability of capital. That's the main one, especially for cannabis companies. I think Richard and his team did a great job. Canada is now the mecca of cannabis. So that creates a few things. First, all the investors are investing here. All the knowledge is in Canada. The liquidity is in Canada as well. And the second thing, I think, compared to the US or other exchanges, the small cap here have some exposure, have some liquidity, it can be covered in research. If you go to other exchanges, if it's below 200-300 million, no one looks at it, no one trades it. So it's a good first step, and for both international and Canadian companies that are smaller, and for the cannabis, obviously, that's the center of the universe to raise capital.
Yes, Sherry, my 2 cents are that if you hope to have operations in the United States or involvement in the U.S. Cannabis industry, the sad reality at present is that you can't list publicly in the United States at this point, regardless of how large you are. So that Canada really is the only viable option for these issuers to both access public capital and all the benefits that flow from that, which we'll be talking about, I think, as this webinar progresses.
Yeah, that points to a question that I get asked frequently, which is why not just list in the United States? And you've just cited the primary reason, which are the challenges with listing a company with U.S.-related activities. Of course, we've seen some companies in the sector that have been able to access U.S. listings if they do not have U.S.-touching activities. But that's limiting if the United States is part of your growth plan.
That's correct. Absolutely. Effectively, the New York Stock Exchange and NASDAQ require a positive representation from the companies that they will be operating in accordance with all applicable laws, which, of course, they believe include federal laws. And as we know, the cannabis continues to be listed on Schedule 1 of the Controlled Substances Act. We've obviously taken a different view from other public markets operating in Canada as well as the United States. Again, we'll probably go into this in some depth, but a considerable part of the disclosure that we require from the companies that are coming onto the Canadian Securities Exchange relates to how they are complying with applicable laws in the jurisdictions that they are choosing to operate. So a considerable part of their listing statement or their prospectus will be not just a description of how they are currently operating in accordance with those rules and principles, but what sort of compliance programs that they have in place to ensure that they will continue to do so, as well as a discussion in the risk factors. What happens if, in fact, you go offside those principles? All of those things are put out in a guidance bulletin that the Canadian Securities Exchange published, which incorporates by reference a number of considerations that the Canadian Securities Administrators similarly put out in a guidance notice last fall.
Mm-hmm. You're right, because it's been very much, for the CSE and the securities regulators across Canada, it's been a disclosure-based approach instead of one of not listing and not getting comfortable with the sector. Time will tell what the passage of the 2018 Farm Bill will do to change that. Obviously, we still need FDA and USDA regulations to be passed. And, of course, if the States Act ever comes into force, that could also change the landscape as well. Let's talk about some of the advantages that we see in going public. And Matt, I'll ask you to start, please.
Yeah, so I see there are three main advantages to go public. First, it's access to capital. Like the capital is more accessible when you're public. For the second reason, that is liquidity. So when you go public, you have liquidity, so early investors can cash part of their investments, new investors can enter the stock. Because there's liquidity, more access to capital. And the third one, it increases valuation. The liquidity increases the valuation, and it gives you a currency to buy other companies. So your shares now have a value because they have a quote, so you can use your shares to buy other companies. So those are the main reasons.
Well, what are some of the considerations or challenges then? Maybe I'll give it back to you, Matt, to do the slide.
So I think the first thing is management they have to realize what's going to happen. When you're public, you don't control your company anymore. The board does. So you can operate as a private company. You have to have quarterly reports, and I'll let my colleagues from accounting and from legal talk about that later in the webinar. But you have to do some reporting. You have less control. You're at risk of being acquired. You can always have an hostile takeover now that you're public. And you have to spend a lot of time, and that's something that often management underestimate, is the time spent on the public side, on the public market side of the business. When you're public, I would say it's half and half. So half executing on your business, half talking to shareholders, talking to potential investors, to research analysts, doing some marketing. So, and a good company can have a bad capital market, and will trade really low. And a great capital market with an average company can trade high as well. So it's really important.
One of the considerations that I actually wanted to underline on this point, Sherry, is that companies really need to think about not where they are right now in the continuum, because these companies are growing very, very fast. They're going to be potentially raising lots of money through different channels, whether it's public, private. There will be mergers and acquisitions activities, and of course they're going a million miles an hour building out their businesses. But one of the things they need to do is basically build a board structure that looks very much like a mature company, and have those governance practices nailed down right from the start. And we've seen this industry is under a microscope, not just from the regulators, but from the broader markets as well. And if you don't have those processes and procedures in place, whether it's for the conflicts of interest, managing conflicts of interest, or non-arm's length transactions or whatever, we've seen the short sellers are going to come after you like, a school of hungry piranhas. And as I say, you better plan to have all of those things locked in, because the successful ones are going to be really big companies really soon. And as I say, you should plan to have those governance practices in place as you join the public markets in the first instance, as opposed to, we'll get to that when we, as we get bigger, having it on your to-do list. Make sure that that's actually pretty high on your list of things to accomplish.
Yeah, it's a really good point, because we tell our clients that are private, and even if they're looking to go public in a year or in the future, to operate as a public company right now, to set up a board, have their reporting procedures in place, so then it facilitates the go public process.
Yeah. Scott Maroof, anything that you would like to add?
Yeah, this is Scott Hammond. I think I couldn't emphasize enough the importance of having the infrastructure in place. Once you've gone through the public process, you could be faced with reporting deadlines that come almost immediately upon the heels of the post-public transaction itself, giving your finance and accounting teams very little time to prepare. So, to the point that was made earlier, you've got to be acting and behaving like a public company well before you ever go public.
Thank you. We thought it might be helpful to illustrate for the listeners on the call two scenarios that we hear quite often when we're getting calls from clients or prospective clients who would like to go public. And scenario A is one that I'll read to you. So any one of us and the group of panelists receive a call, and it's from an extraction facility based in California that has been operating with a state license for 2 years and was recently purchased by new owners. So it's recently gone through a change of control transaction. The new owners have no experience serving on a public board of directors. They have no financial records or legal counsel other than the counsel that they use to acquire this entity. And they're unsure about where to obtain missing records that were not provided by the previous owner. They're interested in doing a reverse takeover because they assume that will be the easier way to go public than doing a traditional IPO, and that it will be faster to do so, possibly less expensive as well. They've never worked with an underwriter or agent, and their capital so far has only been from sales and private loans and from investors. They haven't done any significant capital raising. So we have this as a scenario of someone, as a company that's not quite ready to go public, but I'd like to go around in the group to talk about how we would get this client ready for a go public transaction. And one of them touches upon a point that Richard raised. Collectively as a group, your go public team is going to have to be one that has adequate experience and expertise in the industry and dealing with public companies. And so as a whole, you need to start crafting that team quite early on, because particularly in this sector, it could take you longer to assemble. If you are a company that is an Ontario company, you have to consider residency requirements. In Ontario, and also for our federal companies in Canada, you have a residency requirement of at least 25% Canadian residents. That residency limitation does not apply to companies that are incorporated outside of Canada. You also have to start thinking about your board. So in this scenario, they don't have experience serving on a public board. And what you'll need in order to meet the CSE's listing requirements is that you're going to need, and the requirements under corporate statutes if you're doing an RTO, is a minimum of 3 directors. Of those directors, you'll also have certain audit committee requirements. Companies that are listed on the CSE meet the requirements that apply to venture issuers, and so the independence requirements are slightly different. So you just need to have a majority of your audit committee that are not officers, employees, or control persons. So that goes to, when you're thinking about going public, my first piece of advice is think about who your team will be, both currently in order to get you through that process internally, because it's going to be quite labor intensive to you, but start thinking ahead to who your team will be once you are a public entity. Why don't I go to Richard and see what he sees in this scenario that he would be advising this company?
Well, as Sherry mentioned, the baseline requirements for the Canadian Securities Exchange were designed for the, to be blunt, the mining and oil and gas exploration industry circa 2005 or 6 in Canada. Just because you meet the bare minimum doesn't mean that that's in fact the way you should do it. And as I mentioned previously, these are companies that are going to be complex, fast-growing, and don't think about meeting the bare minimum. In fact, you should be looking to best practices in your governance and overall internal control systems. Again, because of the, not the least of which is, these companies are growing very fast and can be very successful, but also because you are under a regulatory and market microscope to look for slip-ups. So in this space, and I think it's fair to say from a practical perspective, the companies that achieve the best outcomes from a going public transaction in terms of valuation, market support, distribution of shares, and so on, are the ones that do exhibit the level of maturity in their business and management of the operations, as well as their ongoing governance practices. And this company is clearly not at that stage yet. And as you mentioned, Sherry, these are the sorts of things that people, if they do hope to do a public transaction and want a good outcome from that, need to be doing that right out of the gate, as opposed to something that they'll slap together during the roadshow.
Mm-hmm. Yeah, no, I totally agree. And you have only one chance to look good, and the reason you're going public is to have that bump in valuation and have that net liquidity. So management has to do, as Richard mentioned, some marketing and roadshow. If you're not ready, an investor will penalize you drastically. So I would wait. And in that case, I think they're not that far. I would say to hire bankers, lawyers, and accountants early in the process so they can guide you. Because if you're not ready to, it's really, really hard to raise money for you guys. So it's not a race. It's to go public at the right time when you're ready.
And Scott, one of the things in this scenario is the lack of records, and I'm sure that you've run into this before, where there is a gap or an inadequacy in accounting records. Do you have some recommendations on how you work with clients to get to a place where they can produce financial statements that would be required for their go public?
Absolutely, Sherry, and it is in part because of the history of the industry here in the U.S., particularly in some of the states where cannabis has been operating for a longer period of time. Much of the books and records are limited in their nature, and it's an area that we've been having to work with multiple companies on as part of the go public process. And it can be time-consuming a little bit. So to reiterate the point that's been made by others, it is important to start the process well in advance of the decision to go public. And one of the ways that we can help companies, and same with MNP, is we can either work with the companies directly and assist them in getting ready for an audit and helping them rebuild their books and records. Alternatively, we can also provide them with other consultants we work with, so we can provide them access to previously vetted resources that can help them through the process. And then finally, a lot of times the company may in fact have internal resources that are sufficient to go through the process, but they need some hand-holding or help or understanding about not only the reporting needs, but the best practices and ways to rebuild those records. And that's another area that ourselves or MNP can work with companies in this position and help them get where they want to go.
And Scott, it's Maruf here from MNP. Just one thing to add to that, particularly for the cultivators who might be listening in. For the companies that are actually growing cannabis and actually cultivating it, there's a whole additional set of rules that come into play here, which can complicate the accounting aspects, because you basically in a nutshell have to record a lot of these cannabis plants at fair value. So if that's not something that you've done before, and most companies coming into Canada have not dealt with that before, there's a fair bit of time needed to help recreate those particular set of records. So there's a lot of estimation involved. So for those cultivators who are contemplating and go public, we should be adding in a little bit of time on that readiness just on the cannabis account.
Thanks, Maruf. I'd like to jump to the second scenario, which is a company that's more ready to go public. So here, I'll read through the slide. It's a licensed production facility in Oregon, operating for 3 years, is looking to go public in Canada. They do not yet have a board of directors for the public company, but the owner has experience on a public board. They've been working with a local accounting firm to get their financials audited. And they have a local lawyer advising them on next steps. They've raised a certain amount in private financing, but not through an investment bank. But they've raised money through friends and family, or maybe through the accredited investor exemption on their own. The business has all necessary state licenses, and the company believes it can provide a legal opinion that the business is operating in accordance with state requirements, if necessary. And they are interested in doing an IPO. Let's start with Matt.
Yes, I would think it would be a good candidate. Obviously, there's a bit of work to do. Having experience on boards, so management is good. We would also provide a few names for independents, because you have to have some independent board members and board members that the investment community know and respect to give some credibility. Have on the accounting side and legal side, I think they would be ready. And then the next step would be to build their prospectus, do some marketing, and see if they have the right management in place from the capital market side of the business. Usually on the operation side, obviously they're doing well. Mm-hmm. Sometimes we need to add someone that will take care of all the investor relation, all the marketing, mm-hmm. discussion with the research analysts, because that's as I mentioned earlier, it's a big part of the business too.
Yeah, I assume that a company like this one would probably have at least an investor deck that they've used for other purposes or corporate overview. And then they would be working with your team and with the legal team to round out that presentation. I know that from our perspective, particularly if you're doing an offering that's in Canada to Canadian investors, there's certain requirements under securities laws that are required in that deck, and it's all the things that us lawyers like to put in to muddy your deck, and we try to do it in the least intrusive way. But there are things that you will have seen: risk factor disclosure, cautionary statements regarding forward-looking information. Information on if it is considered an offering memorandum in Canada, then there is a requirement to provide statutory rights of withdrawing rescission to investors if there's a misrepresentation in the information that is contained in that deck. Do you want to talk about the investor deck just a little bit?
Yeah, on the investor deck, obviously we rely on our partners' counsel to make sure that all the legal aspect is taken care of. On our side, we start from what the company has, but there's a way that investors want to look at a deck. There's a strategy in building a deck, and there's a few things that we know the investors want to see. So we usually start from what they have, and then propose a few slides, and we work hand in hand with the company. So that's something we build. We build together. So we bring what all the aspect that people want to see from our side. At the same time, they have to provide us with what are the strategic advantages of that company and their strategy going forward.
Thank you. Anything else that either Richard or Maruf or Scott would like to add on this scenario?
Yeah, this is Scott here, and I guess I'd throw a couple things in that when we're working with companies like this and helping them prepare for this process. One of the multi-entity structure is very common with U.S. cannabis operators here in the U.S. and multi-owner as well. And so one of the critical steps that we have to go through and work with the company on is to determine which of those entities are going to be included in the financial statements that will be audited and included as part of the documents submitted as part of the go public process. And so, again, we work collaboratively with the company, counsel, et cetera, to go through that process. It can be somewhat complicated, so again, it's one of those things that you always want to get started earlier on in the process. Another thing I might highlight would simply be the complexity that can come if the entity has either done an acquisition recently or is even just considering an acquisition and has gotten to a certain stage of discussion with the target. Either of those scenarios can create a situation where the acquired company or even the target company, even if the deal hasn't closed, those financials might have to be included in the go public filing as well. And so, again, similarly, that's an area that we would always want to sit down and work with the company, its management and counsel, and figure out what those requirements are well in advance.
Thank you. So what are the questions that you should ask yourself and your leadership team?
Yeah, so I think we touched a lot of these points already. You need to ask yourself, is your company, do you have the right fit to go public? You have growth prospect, you have the right management team, you know that your financial statements will be public, you'll have a lot of scrutiny from your competitors. Do you have any strategy for M&A or future financings? Or, excuse me, if who will be your shareholders? If you own 80% of your stock, it doesn't make really much sense to go public. You'll have no float. And so that's about it. And if you're ready, again, I repeat myself, but you have to be ready to put a lot of time on that capital market side of the business, because a company that doesn't issue any press release, that doesn't do any marketing, becomes an orphan stock with no liquidity at a lower valuation, and it's almost a public company, a private company with all the public requirements, and you don't want to be there.
Yeah, as we like to say, the companies that come in on their first day of listing, they sometimes see it as the achievement of a goal. That's just, in fact, the start of the race.
Yeah,
Absolutely.
Agreed with that. And one of the things, one of the points on this slide that I just want to call out just for the audience is, do we have and implement policies, procedures, controls, and systems adequate for the scrutiny of operating as a public company? And as a legal team, one of the things that we will prepare and work with the company to prepare is a set of governance documents that will set out various policies and procedures for the company to follow as a public company that are either follow requirements under securities law or follow recommendations for good governance. That's a package of documents that you will work with your legal team on. There's also usually some learning curve for a new board and new management team, and as part of the go public process, they're usually in advance or at the first meeting of the newly constituted board of the public company, we would sit down and perhaps give a presentation on best practices for governance. A question that everyone on this call gets: how much does it cost? And we've set out here various buckets. We have audit fees, legal fees, underwriters' commissions, and other maybe advisory fees from related to the transaction. You have tax advisors, marketing, and investor relations that function. Other RTO costs, exchange fees, transfer agents, and everything else. I want to throw to Richard first, because his exchange has made this very easy for everyone because they have fixed costs. So, Richard.
Well, I mean, our part of it is actually, I'm sure, the smallest of anybody represented on the call. It's $13,500 fee to apply and get through the listings process, and then it's $650 a month flat rate throughout the lifespan of your listing on the Canadian Securities Exchange. But I will say, when people grab us at conferences and so on and hold us down and force us to come up with an overall number, our best guesstimate is somewhere between 400 and 600,000 Canadian dollars to run through the entire process. I hope I didn't steal anybody's thunder by saying that, but that's kind of our rule of thumb for a standard transaction.
Yeah.
So on the investment banking side, depending on the transaction, we can have an advisory fee, which would be, if it's an RTO, finding the shell, depending on where the company's at. If let's say we have to build our model, we have to do the deck, we have to do everything, we would charge something around 100,000, by 50,000 to 150 in shares, not in cash. And then on the underwriter's commission, this is pretty market depending on size, and usually for an RTO or RPO financing would be 8% cash and 8% in broker's warrants, so in shares.
Yep. That's his opening offer, by the way.
The audit team's on the call. Are you able to give us an expectation on being able to get through an audit? Let's do it in a scenario where the company does not have financial statements that are already prepared in accordance with IFRS.
It's more. I can maybe start and Scott can certainly jump in. And the audit is probably the hardest elements to pin down with a company. And that's primarily because there's so many factors that go into a company. I mean, the size of the company, how many operations they have, how many facilities they have, how many jurisdictions they're in, all factor in to the discussion. And then absolutely, Sherry, to an earlier point, the readiness of the company is probably the primary determinant. If the auditors need to come in and there's a lot of financial records to clean up, the cost is obviously going to be, directly proportionate to that, versus a company that's well prepared, that, has a sophisticated, financial team. It's obviously going to reduce that. So, the size of the company is also very, very important. So, you can have audits that are, can start at, 30 to 40,000 from, that are smaller, and that's part of that, their cost on a go public, all the way to, hundreds of thousands of dollars for large, complex organizations.
Thank you. On the legal side, it also is dependent on the stage of maturity of the company, the level of engagement of management, and their ability to tell their business story. It also is impacted based on what the company is doing in the context of a go public transaction. And by doing, I mean they are continuing to operate their business. And if there is a lot of movement in that business story, if they're continuing to acquire other entities, if their model or their business story changes that requires reworking or redrafting, then that, of course, adds to time, complexity if there's additional entities, and so on. From a legal perspective, there used to be a perception that doing an RTO was far less expensive than doing an IPO. What we're finding, however, is that the time that it takes to identify a target company, negotiate an LOI, then a definitive agreement, and seek the target company or the shell company approval can take considerably long, and it can also be costly. And so IPOs are typically more expensive than an RTO, though we are seeing that gap narrow. And so for an expectation on legal fees, I don't think that on the low end, it would be unreasonable to see in Canadian dollars on the low end of around $150,000, and then it can go up from there, depending on, again, how much the company is able to run with internally, and of course, the timeline. The more condensed your timeline, the better your business story has developed, the quicker you can get to market, and of course that reduces the amount of time that you spend in a lawyer's office drafting disclosure. Time. I just pointed to time because time can impact costs from a number of perspectives, not just costs from your service providers, but it also costs resource time. It distracts management from what they really should be focusing on, which is their day job. So, Richard, I know that you as an exchange get this question all the time as well. How quickly can we go public? What do you say?
Well, again, this is one of these things you've got to actually hold us down and tickle us or something before we come up with the answer. But the rule of thumb generally is 4 to 6 months following the decision to actually go public. Our recommendation is, and shout out to my colleagues Maroof and Scott, is to retain the auditor first, because on the timeline, that is going to be the longest period of elapsed time in the effort required to go public. So that once the audits are squared away and the financial records are complete, at that point, your lawyers and financial advisors, whether they're investment bankers or exempt market dealers or whatever, can actually then begin to roll up their shirt sleeves and begin to prepare the disclosure documentation, which will form the basis of the application to the Canadian Securities Exchange. And that's true whether you're looking at an IPO direction or reverse takeover or reverse merger, as they apparently call them in the United States. And we obviously see both kinds of transactions coming to market. Echoing your earlier comments, Sherry, there is certainly a perception in certain market circles that the reverse takeover or reverse merger route is faster. Generally speaking, people advising you to do that have a shell in their back pocket that they would like to sell to you. That was a joke. But actually it isn't. They typically do have a shell in the back pocket they'd like to sell to you. And as you say, as we've had such a vast number of companies come into the public markets, not just in the cannabis space, but generally through the reverse takeover, the number of shell candidates which have, because remember, you are inheriting all of the embedded liabilities in that company when you do the transactions. So you have to undertake a very careful due diligence process on that shell corporation. The number of shells that have not that much hair on them is diminishing. And as you say, costs are going up. We're seeing numbers being kicked around now of about $3.5 million in cash that the people controlling the shell are looking for up front, as well as shares in the prospective company. And so there's a substantial amount of dilution that can actually happen by going the IPO route, or sorry, by going the RTO route rather. And there's always the overhang of unwilling shareholders, if you will, when the company finally does hit the markets, that people who'd sort of written off that investment and, oh goodness, there's some bids out there. Well, I'm going to hit that all day long. So we do tend to see better share price performance for the IPOs following their debut than the RTO, because the RTO has that kind of built-in overhang of basically motivated sellers, if you will.
I see Matt nodding.
Yeah, no, and I agree with that. I think I would say it's a case by case, and maybe I can touch on pros and cons of both, because that's a question everybody asks. So on the RTO, is it faster or not? It's usually a little bit faster if everything is good, but as we mentioned, it depends on your due diligence on your shell and on all the legal process. The advantages of going with the RTO route, the shell, if you know who's behind the shell, the investor base, they can provide liquidity, they can push the stock, they can do some marketing. So, and exactly who's behind it when you do your transaction. And from the get-go, you have your 200 shareholders, and you can be up and running and trading. On the flip side, as Richard mentioned, some guys were in the shell at 10 cents, you go public, and the pro forma is at $1. Some will say, oh, I'm flipping my shares. So and you can have some lockup and some structure, but usually that's the consideration. On the IPOs are always cleaner, but at the same time you don't control your investors. When you open your book and you go public, and you build your syndicate, you have a say if it's oversubscribed. People you can cut or no, and there are orders, but usually you don't control if it's a hedge fund, if it's people that's going to dump your stock if it goes up. So you have no control on that, and you have to have 200 shareholders. It's usually possible with retail shareholders. So a firm like Haywood, we have 10 billion of their assets on the retail side. So we can put a lot of people, but you still have to have 200 shareholders regardless of how much money you raise. With your shell, you already have that.
Yeah, well, exactly. Well, with a shell, you know that you're going to hit distribution requirements. Yeah. You also have, with an RTO model, you have a certainty of funding because you're going to do a concurrent financing, likely subscription receipts, maybe debentures, convertible debentures, and you know that you have the funds in escrow pending completion.
If not, you're not going public, exactly.
Exactly.
Yeah.
And before you end up in this long process of a go public transaction without having funds in place. There's other nuances to it, whether you have one team or two legal teams on an RTO. You would probably have two legal teams on an IPO, and on an IPO you have one, and other considerations. But I think we've hit on the main ones. I want to give some time to Richard to do a shout out to why you should list on his exchange, and a shameless plug on why cannabis companies love this exchange.
Well, I guess I'll quickly, I won't actually refer to the slides because I know that we have a number of questions that have come in that are relevant. But as I say, the baseline requirements of the Canadian Securities Exchange are not very high, to be blunt, and were specifically designed as such. But that doesn't necessarily mean that by hitting the minimum you're going to achieve the best outcome for your company. But in a nutshell, the Canadian Securities Exchange will accept companies with operations or expectation of operations in the United States of America. We do accept the representations that the company is operating in accordance with applicable laws, and we work with the companies on their disclosure as well as their analysis of the risks of operating in the particular jurisdictions where they do. To list on the exchange, you do not need a dealer sponsor, so the company can come directly to the exchange. We do not have a capital pool corporation program that is quite popular on the venture exchange. And the issue, of course, with the venture exchange is that if you have hopes of operating in the United States, they will not, in fact, accept companies with those aspirations. For U.S. companies, one of the important considerations that we talk about is ensuring a local market in U.S. dollars in the United States through a quotation on the U.S. over-the-counter trading OTC Markets Group on one of their regulated boards. The benefit of that is not only do you have a market maker or a series of competitive market makers calling a market in the U.S. in U.S. dollars, but when you're on one of the regulated boards, the shares will be available for trading on U.S. discount brokerage platforms, which means that your early-stage investors, your officers, directors, families, friends and family who invested in the stock, your employees, will be able to purchase more stock at a $3 commission on their Schwab or Ameritrade account. So we find that companies have had great success in doing that. It also supports, and again, the benefit of a Canadian Securities Exchange listing is, and this is true of any public company in Canada, you can take advantage of prospectus-exempt capital opportunities in the United States as well. So Reg A, Reg A+, Reg D financing is possible, and in fact is used extensively by companies with their roots in the United States. So typically what we'll see is, there may be a public distribution in Canada, but the fundraising will be reinforced with a number of private placements which are concurrently conducted in the United States. I guess last but not least, the consideration in terms of companies that are looking to stand astride the border, there is nothing preventing a company from deciding at some future date to become an SEC filer through filing an S1. In fact, that makes it a lot easier because you're coming to the party with audited financial statements, history of operation, and so on. Although for U.S. purposes, you will have to translate your Canadian IFRS reporting into U.S. GAAP, which, as Maroof mentioned earlier, if you're a cultivator, is not necessarily an easy exercise. As I say, so companies can choose to, in effect, become reporting issuers in the United States as well.
I think that's a good segue to the next section that I want to make sure that we get to. And I'm going to send it over to Maroof to talk about financial statement requirements.
Thanks, Sherry. As everybody probably gathering, financial statements are a key component to the overall go public filing process. And really, irrespective of whether you end up in an IPO situation or RTO situation, the financial statements are really unchanged. So it's always going to be required. So the basic requirements from a financial statement perspective are, you need 2 years of audited financial statement. Both years have to be audited. And for our U.S. friends on the line, this is a little bit different than U.S. requirements where you typically will see 3 years. That audit requirement, which is normally 2 years in Canada, it could drop to only 1 year for certain smaller size of companies. So if your revenues and assets are under $10 million, you may be able to get away with 1 year. So from a go public perspective, especially for smaller companies, it's fairly streamlined and it's quite practical in terms of the ability to generate that information. So those are your audited annual financial statements. Depending on the timing of your transaction, you may be required to file an interim statement as well. So typically your latest 3-month quarter would also go in. Those financial statements are not required to be audited. However, there is a requirement for sort of a higher level review that is done by your auditor, but it's not as detailed and cumbersome as a full-blown audit. The final piece on the financial statement side is what's called a pro forma financial statement. So that's always going to be required in a reverse takeover or an RTO situation. It may usually not be required in an IPO situation. And so all this pro forma statement is first of all, it's not a projection. You're not forecasting sales and expenses. All the pro forma statements are doing is affecting what the company would look like post public. So it really just reflects the go public transaction, the money you're raising, and it's just showing investors what you would look like as a public company. Those statements are not audited, they're not reviewed. However, there's just a higher level read through and reasonableness check that is done by the audit teams. So on the financial statements, a big takeaway point is that what rules are used to govern these financial statements. And so I think as was referred to earlier, in Canada, all public companies are required to use international financial reporting standards. Unlike the U.S., where we would use U.S. GAAP. U.S. GAAP is typically not acceptable for a go public transaction in Canada. There are a handful of scenarios where we may be able to get there, but usually as part of your planning process, especially for companies that may have historically prepared financial statements under U.S. GAAP or any other foreign accounting standard, you will need to update those to IFRS. For the most part, IFRS is fairly similar. It looks and feels different, but accounting is generally accounting. But there are some nuances, and we refer to one, which is the actual cannabis accounting, that could be quite different. So it's important to get ahead of that. If your financial teams don't have the knowledge base to understand or prepare financial statements under IFRS, then that's something we would want to immediately identify and bring in people that can potentially help you. On the audit requirement side, so we just spoke about the accounting requirements. On the audit requirement side, so overall for public companies in Canada, you are required to have a Canadian registered auditing firm. So if you have a local firm, they may not be usable from a public company perspective. However, pre-public, you could use an unregistered firm. And so if you already have auditors that have audited financial statements, those statements are still relevant, provided that they're in IFRS. However, post-public, you will need to switch into a Canadian registered firm.
Thank you, Maruf.
Sherry, back over to you.
Thank you very much. I'd like to go through some of the common roadblocks that we see. And the first one on here is one that, as a legal team, we encounter frequently. It's recently completed acquisitions, or I would say pending acquisitions, or probable acquisitions. A probable acquisition under securities laws is an acquisition that has advanced to a state where a reasonable person would consider the likelihood of completion to be high. And I know that I'll turn it over to Scott about how that impacts not only your disclosure document, but in particular your financial statements.
Yeah, sure. I think this is something we did touch upon a little bit earlier, that either a recently completed acquisition or even a pending acquisition can require some of the same financial statement requirements that Maruf just spoke about. And I think, as Richard mentioned earlier, because frequently the audit of an entity's financial statements, whether it's the company itself or a to-be-acquired entity or a pending acquisition, can take some time, it's critical that this get identified pretty early on in the process.
Thank you. Scott, and I'm sure you run into this as well, stale or out-of-date financial statements. The process runs longer than you would expect, and you've got to refresh your financials. Yeah, no, absolutely. And again, I think, Sherry, it's okay in the interest of time. I think the slide here does a nice job of summarizing the common roadblocks and some of the issues that we've already talked about earlier. I do want to highlight a couple of things that we maybe haven't given enough attention to for entities that are looking at the go public process, and that's the tax planning aspect. Specifically in the U.S., where you do have some specific tax codes such as 280E that make life more complicated for the companies, and specifically how they impact the go public. We've seen situations where the deal's been prepped and ready to go, but then as the audit process has gotten underway, issues have been raised about a company's positions on 280E that have caused delays, in the structuring, the financing, et cetera. So again, that's an area that I would highlight for the listeners today to pay some attention to and get some tax guidance earlier on. Similarly, the same issue would relate to regulatory compliance. We are dealing with a regulated industry today, and as a result, as part of the due diligence process leading up to and through the go public process, making sure that companies are squared away there is important. Yeah, and I'm sure that you also, one of the things that always comes up early in the discussion is tax treatment for if you have a strong U.S. shareholder base. If we are triggering an inversion on this go public transaction, can you get a tax rollover for the holders in the United States so that there's a deferred tax treatment for them as well?
Yeah, sure. Maybe I can address the inversion piece. One of the key takeaways and this is a particularly U.S. issue for the U.S. founders, what tends to happen on a lot of these cross-border deals is the IRS in the U.S., they have a particular set of rules where, they may not recognize a company departing from the U.S. And so what that means is that even though the company becomes a Canadian public company going forward, the U.S. tax, sort of regime continues to consider that entity a U.S. entity. And of course, on the Canadian side, the Canadian tax authorities consider that company a Canadian taxable entity. So you end up, if potentially with a situation for double taxation because both jurisdictions consider their rights on those entities. So, and that's effectively, for a lot of these, for a lot of companies coming up, you will hear this issue of called inversion. So a lot of that is able to be structured around. And so in a normal case, inversion is not a good thing. However, as you work through the process and we structure it, we actually end up using inversion to the advantage of the founders. And why that is that normally when you exit or depart the U.S., you have certain deemed taxation on any potential gains you may have on exit. And so typically when you're going to a go public transaction, there would be a typical bump up from what an investor or a founder may have invested historically. So as a result, you technically be required to pay a significant amount of tax on departure. The beauty of inversion where we can use that is because the inversion continues to have the U.S. company as a U.S. company, we can structure it such that the founders can avoid any exit tax. So if there's a fair bit of time that goes into structuring this, we've done it a fair bit along with MGO and also Berlis. it's something you need to deal with upfront to make sure that, we can structure it. I would also suggest for the people that are in California that may be listening in, you have an additional burden because California is not aligned to federal rules when it comes to inversion. So there's some additional structuring that needs to happen. So keep that in mind if you're a California company listening to this call.
Thank you. I think that's very helpful. The other main thing that we get from a structuring perspective early on, immersion always comes up in rollover treatment for the founders. In hand with that, we always have a discussion about foreign private issuer. As Richard said earlier, you do not need to be a company that's incorporated in Canada to go public. I think that's a very important fact to say. However, there may be benefits for a company being restructured to be what's considered in the United States, it's a U.S. concept, it's called a foreign private issuer. A foreign private issuer is a company that's incorporated outside of the United States that has a majority of its voting shares beneficially owned by non-U.S. residents. And if you've been looking and tracking a number of cannabis deals recently, you'll see that how companies are structuring for that is through bifurcated share structures. So multiple share classes where you end up with a class of shares that are common shares that may be called subordinate voting shares that are listed on the CSE, and another class of shares called a multiple voting share. There's other names for it, but it's a multiple voting share. It's a share that's fewer in number that contains multiple votes that are held by U.S. residents. And that structuring is, again, in order to achieve a foreign private issuer status. The reason why we care about that is because being a foreign private issuer allows a company to go public in Canada without SEC registration requirements and the application of Sarbanes-Oxley and more onerous requirements. And so you may see this on your transactions as well, and I just wanted to speak briefly on it. It is now 12:04. We tried to, as best as possible, address the number of questions that came in through our presentation as they came in. Unfortunately, we were not able to get to all of them, but I do hope that you continue to reach out to any one of the members on the team, and we'd be happy to, on an individual basis, respond to your questions. All of our contact information will be available, and our names are on this slide. We will also be sending a follow-up piece with the presentation and audio within 1 week of today. Thank you for joining us today. I'd like to thank our panelists who have done an excellent job in giving you an overview of how to go public in Canada. Have a good afternoon.
Thank you.
Thank you.